required to run the business, severed relationships between the remaining owners and key decision makers, external stakeholders such as vendors or financiers, investors or customers. They could potentially be hesitant to parent up with a new person in charge, or loss of a key relationship. So we do want to make sure that we're putting these plans in place. And I know that at this point, you're probably thinking of at least a few small business clients that you were hoping to approach or haven't already, or you've already had some conversation and you're still looking for those solutions. But now you're wondering, how can I help meet these needs of my businesses? Well, as you think about the clients, what I'm going to do is share a few key strategies to help you support that business's needs. With about 59.1% of all small business decision makers being over the age of 50, the businesses need to start taking a closer look at the business and its potential transition plan. This means that the door is wide open and your potential to grow sales within that small business client is now open. The successful small business owner and their key decision makers should already be doing the necessary day-to-day activities. Sorry guys, one moment. Sorry about that. So they're already doing the necessary day-to-day activities to keep that business profitable and the customers happy. But what happens if the unexpected were to take place? Will the business survive if the owner or key decision maker becomes critically ill and is required to take an extended leave of absence? Or even worse, that what if they suddenly died? What happens to the business? We need to see an outlook of, if the worst case scenario happens, will the business be able to survive? So with these questions fresh in your thoughts, how can you help the small businesses with their continuation plan? A successful small business owner should be considering these core strategies at a bare minimum: the key person coverage, buy-sell agreement, business loan protection, and corporate retirement strategies. So I'll take a deeper dive into these strategies for you, hoping that it'll help uncover some opportunity. So leveraging these strategies, how can you really start that discussion with your small business client today? Well, first, make sure that you're actually comfortable talking about these strategies. Take the time and familiarize yourself with each strategy and how it works. How are you going to do that? Well, you're already sitting here with me today, but how are you going to take it forward? Now, I know that any presentation we do, you may not remember every single slide that I went through, but I want you to know the resources you have. You have myself and you have Maggie. Whenever you do have a question, we are able to help you out. And I think a question just came in. Do we have flyers about these strategies? Absolutely. So after this presentation, we're going to be sending you a few flyers that'll go over the business strategies that are available through Foresters. And that hopefully will help facilitate that conversation for you a little bit better. And of course, you want to ask your small business clients that if they currently have a formal business continuation plan already in place. If they do, request a copy of the plan and determine when it was last reviewed. We want to make sure that the information is current. And if they don't speak to the importance of having the continuation plan, offer just to set up a discussion with the business's accountant and lawyer. That may bring up a lot more gaps that they may not have known about before. Review any kind of related materials required to design a solution for these strategies. So your client's lawyer and accountant can advise them on any kind of tax consequences for each strategy. This is really important because each strategy is going to have both positive and negative consequences as it relates to taxes. So it's really important to compare these consequences along with funding options, which is where we leverage life insurance. So propose a plan that really highlights the potential cost efficiencies of funding the plan with life insurance. And during this process, ensure that their lawyer is involved so that any required documentation is properly drafted. We're not the ones that are drafting any documents. We are here as insurance advisors to help fund these options. But it is the lawyer and the accountant that need to be a part of this conversation. So, how does a business-owned life insurance fit into this discussion? The life insurance coverage is going to allow for these. It's going to allow for the potential to purchase more coverage, as some businesses may already have more coverage needed after using their after-tax business income. Tax-free growth, as the coverage may provide access to cash values if the business needs it. Potential ability to fund a buy-sell agreement with life insurance proceeds to provide that funding to help buy out the partner if they die. Protecting the key decision makers with life insurance proceeds, potentially helping eliminate any debt or expenses to help sustain the business while hiring and training a replacement. And an increase in business value, as the coverage potentially helps diversify the business portfolio and reduces business tax on passive assets. So when you're looking at business-owned life insurance, there's two types of coverage that can be considered, term or permanent. So let's just take a quick look at just a high-level difference between the two types of coverages and how they will best fit. So a term insurance is designed to cover those short-term needs expiring in less than 30 years, right? Like the loans, any kind of obligations that they have. It protects the business from financial impact of a death of a business owner or a key decision maker. And it can be used as a collateral for securing a loan. The duration of the coverage period is typically 10, 20, or 30 years, and the coverage does not provide any cash value growth. But the benefit of this coverage is that it's relatively inexpensive form of protection. The beneficiary may receive the proceeds tax-free when the insured dies. Hopping over to the permanent side, permanent is designed to cover long-term needs that may continue well past the 30 years. It protects the business from financial impact of a death of a business owner or a key decision maker, and it can provide assets to fund a buy-sell agreement. It also provides an investment opportunity to diversify the funds not required for their day-to-day operations, and offers, I guess, make sure that we're keeping ourselves moved. Thank you. Sorry, so where was I? So it does provide an investment opportunity to diversify the funds that are needed on a day-to-day basis, and it offers the potential of additional cash flow, leveraging the cash values whenever necessary. The duration of the coverage is typically lifetime of the insured if it's properly funded. Finally, the benefit of the coverage is that it provides tax-deferred cash value growth, and the beneficiary may receive the proceeds tax-free when the insured dies. So how does Foresters Financial fit into this discussion? Foresters is a fraternal benefit society. It's a member-based life insurance provider for everyday families. Foresters is driven to enrich the well-being of their families and the communities. So imagine choosing a company that makes a positive difference in the world. At Foresters, we're driven to share. We're definitely not shareholder-driven. And as a fraternal benefit society, we use profits to benefit members and communities. We're a purpose-driven organization that really focuses on living well by doing good. And we have over 2 million members across 3 countries. With Foresters, your clients are going to get more with membership. Whenever a client becomes a member, as in they've purchased a policy through us, they have access to a whole suite of member benefits they can use to help enrich their lives, such as the Foresters Go, community grants, Law Assure, where they can create a customized will, power of attorney, and medical directive. And these member benefits are free of cost. As long as you've purchased a policy, you're eligible for this membership. So now that we've discussed some of the basics, let's take a deeper dive into the strategies with a key person coverage. So a key person coverage is designed to potentially help protect the financial position of the business against any substantial impact due to a traumatic event. That could be even a critical illness or a death of a key decision maker. Now, who exactly is a key decision maker? Well, an employee maybe with a highly specialized technical knowledge or industry experience. Could be an employee with a reputation in the industry or community who is key to the business's success. Or an employee responsible for securing a significant amount of revenue that will take a long time to replace. For small businesses, investors, or lenders, they may require coverage on these key decision makers in addition to the owner. Now, how does it really work? The good news is that it's actually a very straightforward concept to understand. The business will purchase and pay for the required premiums for life insurance coverage or critical illness coverage on the key decision maker's life. If the key decision maker dies or suffers a critical illness, the business will receive the benefits it's eligible under that plan, and generally is going to be tax-free. So let's take a look at the 6 potential benefits of a key person coverage. The key person coverage can help minimize the potential loss of revenue, sales, and profits, cover any kind of costs of finding and hiring a replacement, providing any necessary liquidity, pay off any debts that may be called resulting from the death, cover the impact of a required write-down of the business's debt, and keep staff and maintain partner relationships. So to illustrate how key person coverage works, here's a look at Happy Smiles Family Dental Care's case. So we have Joseph, who's 59. He's in excellent health. He owns a dental practice with 3 locations. He has an office manager who takes care of all 3 locations for him. And each location has a dentist, a dental assistant, 4 dental hygienists, and 2 front desk receptionists. On a temporary basis, the dentist or dental assistants can pivot between the locations, but if there's an absence, it causes a major disruption. Now, a recent situation made Joseph realize that the loss of a dentist or a dental assistant could really lead to loss of customers, loss of revenue, which could even force him to close a location. So as a result, he's looking to place life insurance coverage on each dentist and dental assistant to help protect his thriving business. Now, with Joseph's concerns discussed, you offer Joseph a term 20 with a death benefit of $500,000 for each dentist and $250,000 for each dental assistant. The total premium for all 6 coverages comes up to just $293. That's a lot less daunting conversation, isn't it? A lot of us usually think that when it comes to business owner policies, it's extremely expensive, you're not sure how you're going to handle it, but really, it's not always about large premiums, it's about the right coverage for the right client. Foresters goes well above and beyond the life insurance coverage. The membership benefits offers Joseph's key employees access to Foresters Go. This is a really fun wellness app that is made so that you can do some challenges, earn some points, and those can then turn into rewards. And Joseph offers this to his key employees, which will really help with his employee retention. Now, let's turn our attention to a buy-sell agreement. We're going to look at what the buy-sell agreement is, how it works, provide you some case study. Just going to check the chat to see if there was any questions in the meantime. Okay. Well, it looks like Maggie's already all over it. Fantastic. So a buy-sell agreement is a legally binding contract that outlines how the business will reassign those business shares of an owner who could either have died or left the business. The contract may also establish a method on how to value the business, how the value will be determined at that time. So the business can typically have several approaches to this to determining the purchase price of the business. Could either be an agreed upon value, Could be using a formula, could be an independent appraisal, or a book or fair market value. And this is something that the business owners need to decide on how they want to handle it in the future. So, what could happen if a buy-sell agreement was not put in place? The deceased owner's shares would go to the estate, and the owner's beneficiary would become owner of those shares, potentially leading to tension among the owners, a need to sell the shares when there's no available buyer, a disagreement over the price of the shares, and the remaining business owners may not have the sufficient funds to purchase those shares from the estate, and the new owner could end up having a majority control, and that could change the direction of the business unwantedly. So there's a lot of impact if this buy-sell agreement is not put in place. So there are various ways that a buy-sell agreement can be structured. You could use a crisscross method, a promissory note, a share redemption, or a hybrid method. Now, let's look at these methods one by one, okay? And we're going to use the business owners Steve and Michael in our examples. So first off, let's take a look at the crisscross method. Step 1, create a binding crisscross buy-sell agreement, determining the method of calculating the business value. Each business owner will purchase a life insurance coverage on each other's life. Step 2, when Steve passes, his ownership shares in the business and the insurance coverage he owns on Michael will go to the estate. Michael will purchase Steve's shares using the life insurance proceeds and become 100% owner. Steve's estate can transfer the life insurance contract to Michael for fair market value or cancel and let the coverage lapse. A lot of flexibility to each of these business owners. Now, how does a promissory note method work? First, you're going to create a binding buy-sell agreement leveraging a promissory note, which defines an agreed-upon purchase price. The business is going to purchase the life insurance on each owner. When Steve passes, his ownership shares in the business go to the estate. The business will receive the life insurance proceeds, and they'll use these funds to pay Michael a capital dividend. Michael purchases Steve's shares using the promissory note and the capital dividend received from the business, and then he becomes 100% owner. Step 5, the purchase discharges that promissory note. Next up is the redemption method. This is going to be step 1, creating a binding redemption buy-sell agreement, determining a method of calculating the business value. The business will purchase life insurance on each of the owners. When Steve passes, his ownership shares in the business go to the estate. The business receives life insurance proceeds, and they use these funds to redeem the shares from Steve's estate. Michael's shares represent 100% of the business post the redemption of Steve's shares. And the last one on the list is the hybrid method. Step 1, you're going to create a hybrid buy-sell agreement leveraging a promissory note, which is going to define an agreed-upon purchase price for that portion, and a redemption method. So it's a mix of both methods in here. The business will purchase life insurance on each owner. When Steve passes, his ownership shares in the business go to the estate. The business receives life insurance proceeds. A portion is paid to Michael as a capital dividend, and a portion is used to redeem the remaining shares. Michael purchases the portion of Steve's shares using the promissory note and the capital dividend he receives from the business and becomes 100% owner. So what are the potential benefits of this buy-sell agreement? Well, this buy-sell agreement is going to provide the funds to create a fair market value exchange. It may provide the heirs a known buyer for the business so that they don't have to pick someone who may not be qualified. Promotes orderly and equitable transfer of the business, voting controls, and the management. It can create stability for the remaining owners and the key non-owner employees. Potential tax advantages here. And of course, it may provide estate liquidity to cover taxes, any debts, and any other estate settlement costs. So to close the loop on this buy-sell agreement, we're going to look at Pro-Angle Construction's case study. Michael, who's 40, and Steve, who's 43, both are in excellent health, and they're co-owners to Pro-Angle Construction. Over the past 15 years, two best friends built a $7 million business. They expect this business to continuously grow. Now, recently a close friend had died, and that really got them thinking that what would happen to their business that they built if one of them were to pass away or have a critical illness. So they meet with their accountant, their lawyer, and their insurance advisor to discuss different ways of ensuring this business has continuation strategy put in. So what they want to ensure is that any outside investors don't get involved.
Excuse me, Monica. Would you please close the window that is on the screen?
Oh, thank you for that. Okay, so they want to make sure that there's no outside investors getting involved. The partners' spouses are not forced to be involved, and that they can sell the business when they're ready to retire. Their retirement goal is at the age of 60. So based on their accountant and lawyer's recommendation, they agree on a crisscross buy-sell agreement for the purchase and sale of their shares of the business. The agreement calls for a formula to determine the business valuation. Now, based on their insurance advisor's recommendation, they both agree on purchasing a 20-pay Advantage Plus whole life. This is going to have a base coverage of $2 million with paid-up additional options to help potentially meet those buy-sell agreements of a growing business. This is going to include a Term 20 rider for $1.5 million. And this plan is going to provide flexibility to access funds through a tax advantage collateral loan using the cash value line of credit. So for Certificate 1, Steve is going to be the owner and Michael is the insured. The coverage assumes a non-smoker class, paid up additional insurance option, Term 20 rider, and the premium is $50,000 annually for 20 years. And has non-guaranteed assumptions. The initial insurance design shows that Steve will have $3.5 million in death benefit protection on Michael, and $2 million of the base coverage, and $1.5 million of Term 20. At the age of 50, the certificate will have non-guaranteed values of $163,000 and a death benefit of $3.7 million. Even if declared dividends didn't perform as expected, you can see that even at 10% or 15% reduction in dividends, the certificate values still build a substantial value for them. At the age of 60, the certificate will have 1.05 of cash values and death benefit of $4.2 million. Certificate 2, Michael is the owner and Steve is the insured. So the coverage assumes the same non-smoker risk class, got a paid-up additional insurance, Term 20 rider, premiums are $55,000 for the next 20 years. So the initial coverage is going to show that Michael will have $3.5 million in death benefit protection on Steve, $2 million of base coverage, $1.5 of Term 20. So they're mimicking the exact same values here. So at the age of 50, there's going to be cash values of $84,000 and a death benefit of $3.6 million. Even if the dividends don't perform as well as expected, at age 60, you're expecting around $700,000 in cash values and a death benefit of $4 million. Now, Foresters membership provides Michael and Steve the opportunity to apply for community grants. Now, the partners decide to pool their efforts by applying for the community volunteer grants to help a homeless shelter. Both of the grants are approved, and they're able to buy the supplies that are needed with pay cards through Foresters. The event is posted on Foresters member portal, myforesters.com, and 25 members volunteer to help assemble these care packages and deliver them to the shelter. Pictures of the event are, of course, posted on social media. Nowadays, what isn't, right? And all those volunteers posted all different pictures, drawing a lot of attention of the local media. The media coverage helps raise Michael and Steve's profile in their community. Now, let's turn our attention to a business loan protection. Now, a business loan protection is designed to help repay any kind of outstanding business loans in the event of death or critical illness of a key decision maker. The protection amount should reflect the outstanding loan balance, including commercial loans, any mortgages, venture capital loans, personal guarantees, and director's loans. The protection could be in the form of a business owner life insurance or lending institution insurance. So why might the business owner life insurance be a better fit? The life insurance premiums are generally not deductible, except for collateral insurance, part of an employee's remuneration, or charitable gift. So the business receives the death benefit generally tax-free, which may flow to the business shareholders. Upon receipt of the death benefit amount, the capital dividend account is created in the amount of the death benefit less any adjusted cost basis. So when are the premiums deductible for a business? When coverage is required as a collateral loan from the bank. So the business must take a loan from a financial institution. The interest on the loan must be deductible. Financial institutions must require life insurance coverage as a collateral for the loan. The certificate must be collaterally assigned to the financial institution, and the owner of the life insurance and the borrower of the funds must be the same taxpayer. Now, having had the opportunity to discuss business loan coverage, what are the differences between that and lending institution coverage? So over here, you're going to see both sides. The death benefit on a business loan policy is constant. Lending institution is usually decreasing as that loan goes down. Who controls the death benefit? Well, in a business loan policy, your business will. And on the lending institution side, your business doesn't have as much control. So the lending institution will be taking the decisions. What if you move or change lenders? With the business loan policy, it's portable, so the insurance stays the same. Insurance is canceled, however, on the lending institution side. What happens if your loan is paid off? Business-owned insurance, the coverage will continue as is. And on the lending institution side, the insurance will be canceled. Now, can this product be converted to other plans? On the business owner side, yes, you can. Is the premium deductible? Yes, on the business owner side it is. And is a capital dividend account available? The capital dividend would be available on both sides, the business owned and the lending institution. So I am seeing a lot of requests coming in for marketing material. Guys, we will already be sending an email to everyone. You do not need to provide any extra emails. You already gave that to us when you registered. So we'll send a recap of this presentation with some marketing materials for everyone. Okay. So how does the business loan protection really work? The good news is that even this is a very straightforward strategy. So the business will take a loan out from a financial institution. The business then purchases and pays for the required premiums for a life insurance coverage or critical illness on the key decision maker's life. This coverage is used as a collateral to secure the loan and receive the loan amount. If that key decision maker dies or suffers a CI, the business will receive the benefit it's eligible to under that plan, which is used to repay any outstanding loan balances. Now, what are the potential benefits? Well, you can maintain your financial capability to secure or repay those loans, flexibility to continue the business as usual until the key decision maker can return or if a replacement is found. This may provide funds to help maintain that cash flow to meet any outstanding loan repayment schedules. Typically, insurance is a prerequisite for financial institutions before a loan is funded. And it may provide those necessary funds to help implement a new business strategy for the retaining key existing or attracting new relationships. So to close the loop on business loan protection, we're looking at License to Grow's case study here. Bob, who's 54, is in good health, built a career in the restaurant industry, working in various restaurants. And his dream is to open his very own restaurant. Well, that time is now. To open License to Grow, Bob requires a $200,000 loan for remodeling and equipment. The loan is approved, but the bank requires a collateral before funds are disbursed. So you offer Bob a term 10 with a death benefit of $200,000 and a Live Well Plus term, which is a critical illness insurance policy, with a benefit of $100,000. The total monthly cost for both policies comes up to $243. The Live Well Plus policy provides a lump sum benefit if diagnosed with one of the 25 illnesses that are covered with the policy. The nice feature is that the coverage, it doesn't have any additional certificate fees, so no policy fees on the critical illness. Now, Foresters Member Benefits provides Bob access to lifelong learning. This is a member-only online library offering a whole diverse range of topics, including business management, communication, and professional development. So as a new business owner and a Foresters member, Bob can use lifelong learning to update his business skills and to help him run a successful restaurant. He even decides to take a photography course to help him learn how to take stunning pictures of the food and to promote his business on social media. Now we're going to talk about corporate retirement strategy. So corporate retirement strategy is designed to help small businesses with providing a tax-free death benefit amount for today and to build tax-deferred cash value accumulation for tomorrow. Providing a stream of tax-free retirement income, leveraging the policy as a collateral for loan instead of taking out withdrawals directly from the life insurance policy. Why might this be important to small business owners? Well, today about 80 to 90% of small business assets typically are tied up in the business. So they are going to be looking for that extra funding. So how does the corporate retirement strategy work during retirement? Well, the business purchases and pays for the required premiums for the life insurance coverage on a key decision maker's life. The business uses life insurance coverage as a collateral for a loan. A third-party financial institution gives a loan to the business owner, who then pays out a dividend to the key decision maker. How does that work on death? Well, the life insurance company pays the business the benefit it's eligible under the specific insurance contract. So whatever the death benefit is, it goes straight to the business. The business will use the life insurance proceeds to pay the outstanding loan to that third-party lender, and any excess death benefit amount minus any adjusted cost base is then paid to the business's capital dividend account. So how can life insurance complement your retirement strategy? Life insurance and critical illness insurance shouldn't necessarily replace any other savings vehicles, such as registered pension plans, RRSPs, private pension plans, or tax-free savings accounts. Rather, life insurance is really there to help boost the retirement strategy due to the plan limitations, restrictions on any fundings, tax benefits, or an abrupt end to funding due to the loss of income of an unexpected death. So taking a look at 5 potential benefits of the business owner policies. Generally, income is tax-free, death benefit, no contribution limits, tax-deferred growth, tax-advantaged distribution, and no required distribution, as in you're not forced to take any money if you don't need it. So, talking about Tina here, she's a 51-year-old single parent. She's the sole owner of Budget Busters, which is an accounting firm, and she has a daughter who's recently started university 350 kilometers away from her. She has 3 times her annual salary in group life insurance, which terminates at the age of 65. Now she's got a few assets, including $350,000 in RSPs, $50,000 in TFSA, and $20,000 in non-registered funds. So you know she's already got a strong mind on putting these savings into play. But she wants more. Now, just like most loving parents out there, Tina is looking to ensure that her daughter is first and foremost taken care of financially in the event of her premature death. She wants to explore opportunities on how to supplement her retirement income to complement her RSP accounts, which are exposed to market fluctuations. And because of where her funds are, she wants a safer route as well. So she plans to take out a late pension because the CPP and OAS, if you push it to 70, she'll get a higher payout. So we don't know if these plans are going to be changing in the future, but as of today, what she plans to do is to get that increase, she's going to start taking payments out after 70. So to supplement from 65 to 70, she is looking for an option right now. So she's ready to allocate $600 per month to implement a retirement strategy. And it's good to know that she's maximizing her RSP and deferred contributions and the TFSA contributions. So here's the game plan. Budget Busters Inc. purchases the following on Tina's life: an Advantage Plus PAR certificate for 20 pay with paid up additions as a dividend option. The base coverage is $125,000 and a $200,000 term 20 rider to provide for that additional protection after retirement. The total coverage costs about $408 per month. Other than that, her goal is to be able to have access to funds to supplement her retirement and delay that CPP and OAS payment. Delaying the CPP and OAS payment is not feasible for everybody, but if you are able to wait, cashing in early just doesn't always make sense. But she can wait. So she can do this through using the collateral assignment of the policy's cash values at some time in the future. And there's a way to help increase these growing cash values in the policy. Advantage Plus provides the clients the option to put additional deposits into the policy so we can add additional purchase option for $191 per month for 15 years on her plan. That is going to fit the budget that she had of $600. And it also provides for flexibility to request withdrawals of cash values to pay for premiums. So let's take a look at this and break it down. Tina would benefit from the total coverage of $325,000, made up of $125,000 of whole life and $200,000 of a T20 rider. $600 per month premium is a premium of the insurance plus the additional deposits to help with the policy's cash values. At the age of 66, when Tina retires, the policy will be on its 15th anniversary year. Now, Tina decides that she no longer needs the term 20 rider, and she cancels it. The total cash value based on the current dividend scale would be $79,000 at this time. So Tina would be in a position to take a collateral loan for up to $20,000 per year for the next 4 years. And she can use these proceeds as a supplement to her retirement income. The money she receives as a collateral loan allows her to defer that CPP and OAS, maximizing her payments. And if she sticks to the plan and she takes $20,000 every single year for the next 4 years, her total loan would be $80,000. At the age of 80, her total loan balance would be $147,000, assuming the annual interest rate of 5%. At this time, she would still be able to continue getting a loan of $60,000. If she passes away at 80, Foresters would forward some of the proceeds of the death benefit to pay for that outstanding loan of $147,000, and her beneficiary would receive the remaining $137,000 as a death benefit. So in this case, she's able to use that money for her retirement and still be able to pass money through to her daughter. Now, if she wanted to see an alternative scenario where today's current dividend scale does not produce the projected values, you would see that assuming a 15% reduction, she would be able to get the $80,000 loan, but if she passes away at 80, her beneficiary would receive $119,000 at death after the loan is being paid. So remember that this is a life insurance and it will be able to help provide for the financial support that her daughter needs at the time of Tina's death. Statistically speaking, women do tend to live longer than men, but they do have a higher chance of getting sick compared to most men. So that's why a corporate retirement strategy also involves having a critical illness insurance in place. A few slides earlier, you saw that Tina has a combined $70,000 of accessible cash from her TFSA and non-registered funds. These are funds that she's putting away to fund her lifestyle in retirement, like traveling or buying a nice vacation home or even a nice car. In the event of an illness, if she doesn't have that critical illness insurance in place, that money that she's been putting away to enjoy that retirement would be put into an emergency fund money. And again, many clients think that when a serious illness strikes, publicly funded healthcare would take care of everything. But of course, there are expenses that come out of pocket, such as lost wages, parking, food, mortgage, rent, amongst many other things. To protect against the situation, business purchases a Live Well Plus Term 20 policy for Tina with $125,000 of coverage for a monthly premium of $149. Now, with member benefits, families can apply for tuition scholarships to help with the rising cost of post-secondary education. So now that Tina has a policy, Tina's daughter is going to be eligible to apply for a Foresters Competitive Scholarship. We give out 300 scholarships every year, up to $2,500 each year. The students can reapply for up to 4 years, and that application requirement is 65% is based on community hours of 200 service hours, and 35% of the decision is based on the grades. You need a 3.2 average or higher. And this is there to help ease that burden of higher education. So this is your time to help your small business clients grow in partnership with Foresters. The Building a Better Business presentation is really just meant to provide you with an overview of various strategies and solutions that Foresters can assist you with towards protecting the small business clients and helping them be best positioned for growth. It is going to provide financial protection when it matters most to the business, opportunities to raise the company profile by making a difference within the community, business networking opportunities, and personal and staff skill development opportunities. So if you're ready to get started, I'm just going to give you a quick recap of where our highlights are. So at Foresters, it is a really good option by using enhanced dividend option for any clients that you feel may be rated, but they're looking for that permanent coverage. Any estate transfers, and especially corporations like we talked today, we absolutely shine. At Foresters, our ACV erodes much faster than most other companies out there, almost 10 years faster, meaning we're able to give out more in hand through the CDA tax-free to the shareholders' beneficiaries. We've done a term reprice recently, so we are looking excellent for ages 30 to 50 right now. And there's no initial paramedical or lab work needed for policies up to $1 million for ages 18 to 50 and $500,000 for ages 51 to 55. Anything outside of these ranges will be a medical required. We also have a quit smoking incentive, which is a fabulous deal for anyone who is a smoker. Whether you're trying to quit or not, the very first 2 years of any permanent policy, we're going to offer as a non-smoker rating. If the client quits smoking in those first 2 years, they'll get to keep those lower premiums. And if they continue to smoke, as of the 3rd year, smoker rates will start. But something you should note is that even those smoker rates as of the 3rd year are one of the lowest in the market. So whenever you have a smoker client, please, I really encourage you, bring it to me and Maggie. I'd love to send you a quote to show you exactly how competitive we are. And another benefit that we have is a charity death benefit. On our term policies and Advantage Plus, our PAR, when the client dies, the beneficiary will receive the death benefit amount. Foresters will pay an additional 1% of the death benefit if a client has named a charity on their policy. So that 1% will be paid by Foresters to that charity on behalf of the client, meaning even that charitable tax receipt that they would be issued will go to the client's estate. So it's a win-win at that time. Now, if you're not able to serve the clients through our traditional route, you also have Canada Protection Plan, where we are able to offer up to $750,000 of no medical life insurance and $100,000 of no medical critical illness. There's no questions about occupation. There's only one question about travel, and we keep it very, very easy for most clients to get coverage. Any thrill seekers, we do offer up to $500,000 of coverage. To apply, you don't need any financial information, no medicals, no APSs, and any policies that are generally in good order right now are actually being pushed out within just about 5 days and working on better and better turnaround times for everyone here. When it comes to marijuana usage, that is a really big topic right now because, yeah, marijuana has been legalized, so more people are partaking. With Canada Protection Plan, you can go up to 6 times a week of smoking marijuana to still be considered as non-smoker rates. If the client smokes more than 6 times, so 7 or more, then this is going to be a smoker client, not a decline. We know that many carriers out there, when it comes to coverages, after a certain amount, you will be declined for marijuana usage. But with CPP, we're not declining anyone. When it comes to any clients with criminal history, we do have multiple plans available depending on when they last dealt with that criminal history. And just last year, we improved our plans. So any diabetics and any clients with heart issues more than just 4 years ago are now eligible for one of our best plans, which is Simplified Elite, up to $500,000, no medical, and no deferral conditions. Just to give you a little bit of a highlight on what's to come soon, we are coming out with a brand new product, which is going to be a bit of a hybrid of what we currently have, which is our estate plan, and kind of in the middle of an estate and accelerated plan, so the ones with the higher cash values. So our plan, after the 15 years, we're going to have amazing cash values. This is ideal for that juvenile market, anyone looking for an IRP solution, and we're now going to be offering a joint last to die available on our PAR plans. We have that intergenerational transfer of wealth going on, and we want to make sure that we're offering clients the highest death benefits. So this plan is going to be ideal for that. And along with the new product, we're also coming out with a new online application. So when this new plan comes out, it's coming with a new app. So I'm looking forward to these changes and, of course, growing your business along with it. Talking about your business, I want to show you how your business can be rewarded. Our incentives for 2025, on the Canada Protection Plan side, when you do a minimum $10,000 of net FYC, we'll put you on a bonus program of 15%. If you maintain that $10,000 every single year, we'll bump you up into a higher and higher bonus structure, all the way up to 30% bonus. On the Forester side, you have $10,000 of net FYC will put you on a bonus program of 15%. The more business you do, the higher bonus you can earn. Now, I am sharing my contact information here. You're more than welcome to call, email, text, WhatsApp, whatever is more convenient. Please do reach out. And of course, my partner, Maggie, she's the regional sales manager. You can also reach out to her for any questions, any quotes, any sales support that you're looking for. We're both here to help you out at any time. Other than that, thank you so much for joining me today. I am going to just take a look at to see if we have any further questions. Sorry, my Zoom. There we go. Let's see here. So there's a question here, how do they take a policy to repay the loan based on the previous slide? It basically means that when there's a loan that needs to be paid, a lot of the banking institutions will ask you to get a life insurance as collateral. So you would just open up a life insurance policy and show that as your collateral for that loan. Okay, don't think we have any other questions. I'm going to leave the presentation still open here. If anyone has any questions, you're welcome to unmute. Stay on for another 2 more minutes so you can hit that 1 hour mark and we can get you that CE credit for today. Now, there's a question online here that do we have any specific banking institution that we're using for the collateral loans? We are working with Equitable Bank, the EQ Bank, but there's no restrictions on which bank you use for that collateral loan. You're more than welcome to take it to any bank that can use the cash values.
Hi, Monica.
Hi, Erica. How are you?
Good. Monica, very quickly. On February 6th, you had a presentation at VFG.
Okay.
Don Xavier.
Okay.
I attended that presentation.
Okay.
I even spoke with you because I submitted one application. I needed your help, and thank you. I am using this opportunity to really thank you.
Oh, thank you.
And one more thing.
Yes.
I still haven't received CE credit for that.
For that one? Sure.
Yes.
If you want to just send me a quick email, I can check in with my CE credits department. Usually it shouldn't take any more than 30 days, but whenever it passes that 30 days, I'm more than happy to follow up with that.
No problem. Thank you very much. See you tomorrow.
Okay, I'll see you then. So there's a question here that says, if the insured dies, do we require health information for the claim? Now, our claims process is the same as any other company out there. We are upfront underwriting, so we've done all of the work in the beginning. But when there's contestable times, we are going to be asking for more documents and more follow-up on, for example, in the first 2 years, if the client dies, yes, there will be a lot more documentation requested. But after the contestable times, usually no, there's not any health information needed at that time. If there are cash values in the earlier years, as long as it's more than $500, you are able to apply for those collateral loans. Yes. You guys have amazing questions today. I love this. I'm hoping I didn't miss any. If anyone has a question still, please definitely ask. Can the business claim tax for policy premiums? I don't think that that's always the case. It's very specific situations when a business can actually use the premiums as expense. But that was shared as a part of my presentation, so I really encourage you, Evelyn, to reach out to me. I can go over that slide again for you, but this is more of a question for an accountant. They're the right people to go to whenever you do have a taxation question, especially when something can be expensed or not. Usually, life insurance or critical illness premiums are not expenses to the business. Any kind of loans that are being taken out, if it's a business policy, it's a business loan. It is not a personal loan. All right, we've passed our 2 o'clock mark, so thank you everyone for joining. Please reach out to us whenever you have a client that you're working on. Let us compare the best strategies out there for your client, and I'd be happy to help you grow your business. Have a fantastic day.
Thanks, Monica. Have a great day.
You as well. Take care.
Thank you. Thank you
Bye.
so much, Monica.
Anytime.
Thank you.
Okay.
Great presentation, Monica.
Thank
Pearl.
you. Appreciate that, Pearl. There's a question, if term loans apply? Yeah, even if it is a short-term loan, you can get short-term coverage for them, such as a term product to help supplement that. Absolutely. Have a great day. Bye.
Thank you.